What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over 5 cheap stocks that you should consider buying right now according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analyses to see whether these 5 companies either belong in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being amazing and if this video has provided you a lot of value, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without a further ado, let's get this video started. So 5 cheap stocks to buy with high yield and good earning power. These 5 stocks have some great cheap options by Mark R. Haig, CFA. In this technology-centric market, I wanted to find some cheap stocks to buy with high yields, and those earnings power would be sufficient for the dividends. In turn, this will allow investors to receive present income while they also wait for the underlying stock to recover to their previous highs. Additionally, another advantage is that investors can use these stocks in a barbell, so to speak, investing strategy approach. This is where you put higher valuation technology stocks in one portion of your portfolio. Typically, though, these stocks do not pay dividends, so the other end of the barbell, you invest an equal and nearly equal weight in cheap, high-yielding dividend stocks. In turn, this allows you to benefit from both worlds, growth and value investing. It helps your portfolio to have present income and the possibility of offset gains from each type of investing. Thus, when your growth stocks start to falter, the cheap, high-yield stocks will tend to move up and vice versa. With all of that in mind, I've honed in on a few that have expected earnings and or free cash flows for the next year. However, they still sell for less than 11 to 12 times earnings for the next year. In addition, the average dividend yield of this group is 2 to 3 times the average dividend yield of the S&P 500 index. So here are 5 cheap stocks to buy right now. Let's dive in and look at these stocks. So the first company in this list is NetApp, ticker symbol NTAP. The market capitalization is around $10.05 billion. The dividend yield is 4.5%. So NetApp is a physical flash array and cloud-based data storage company. For the current fiscal year, earnings are expected to take a dip to $3.27 per share from $4.05 last year. However, in 2021, analysts polled by Yahoo Finance expect its earnings power to rebound back to $4.02. Meanwhile, this company's earnings more than cover its annual $1.29 dividend. It is also one of the few technology stocks that also buybacks its shares. In fact, one of its chief advantages of buybacks is that it allows the company to continue to grow its dividends per share without any further outlay of cash. That said, my analysis of the stock is that it is worth significantly more than its present price. For example, the average dividend yield for NTAP stock over the past 4 years, according to Seeking Alpha, is 2.37%. Today, it's yielding 4.5%. That implies that if the stock were to rise to the point where it enjoyed its average yield of stock would be worth around $81.01 or 91% above today's price. Moreover, another way to value NTAP stock is to look at its average price to earnings ratio. That said, Morningstar has a page showing that the average price to earnings ratio over the past 5 years was 27.3 times. Applying that ratio to NetApp would give it a target price of $89.68. So the average of these two methods provides a potential upside target for $85.35. That represents a gain of 102%. Additionally, if that took 3 years to achieve, the average compounding return annual would be 26.4% each year. And if you add in the annual 4.5 dividend yield, that would be around 30% annually. This is pretty good ROI, and NTAP is pretty good cheap stock to buy. Okay, So I understand there's like a lot of upside potential in terms of its price to earnings multiple and the dividends that it's being paying out, but let's see if it meets any of our criteria. So NTAP, we can see that the price to earnings multiple is nearly 50% low when compared to the S&P 500 index. In order for a particular company to meet my dividend portfolio, it needs to basically meet 4 rules, right? And these 4 rules are based on 3 books that I've read and which I totally love and I've picked up on, and my perspective on these books, right? The first book is Dividends Still Don't Lie by Kelly Wright. They run their own investment quality trends called the IQ Trends website, which is purely based on dividend investing. I highly recommended to check it out. The second book is Get Rich with Dividends by Mark, and the third book is The Ultimate Dividend Playbook by Josh Peters, who's an editor at Morningstar. So the dividend portfolio 4 rules are as follows. Rule number 1 is that the current free cash flows must be positive. So you want to be investing in companies which are physically bringing in cash, so that you know that your money is working for you, right? Rather than not knowing what the company might do today, tomorrow, or day after tomorrow. Yeah. So rule number 2 is that the dividends that are being paid out should not be more than 75% of the current free cash flows. So what we are trying to achieve with rule number 2 is we're trying to make sure that at least 25% of the free cash flows, like I know like few companies don't require that much amount of the free cash flows because they're almost like matured companies and there's not that much growth prospects associated with it. So the management doesn't know what to do with the money. Rather than that, it gives it to the investors. But we want to be making sure that at least 25% is being retained back into the company, because you never know what the future might entail. And if there are any crazy storms that the company might face, it should be able to clear it off or have at least some financial backing in order to clear it off, right? And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. So beautiful and wonderful companies as such, they generally tend to grow their dividends year over year basis. And we want to be looking at companies that have been growing dividends at least for the past 5 years. If you want to be on the more conservative side, you can consider 10 years or more than 10 years. And rule number 4 is our buy criteria. So we only want to be buying these companies when the current dividend yield is greater than or equal to 5% of the 5-year dividend yield average. Now let's have a look at this, right? So NTAP, I like to use Y charts because they do a really good visual representation of the financial information. So we can see that the revenues 10 years from now is $5 billion. So it hasn't moved that much because the current revenue is 5.412, and the free cash flows have been falling over the past 10 years, which is not a good sign, but nevertheless, the free cash flows are positive. So the first part of the checklist is met. Now let's see how much the dividends are accounting to. $0.439 million divided by $0.936 million. So around 46% of the free cash flows is being paid out as dividend, and the remaining 54% can be reinvested back into the company by the management. Okay, so that's definitely met as well. Now let's see how consistent that the dividend has been increasing for. How many years basically? So it's been growing its dividends for 7 years at a rate of 22.81%. Sorry guys. 22.81%. That is just pretty phenomenal. Just imagine you going to work, not doing anything, and just for owning this particular company, they're growing its dividends or increasing the dividends to you at a rate of 22% every single year for the past 5 years. So it definitely does meet our criteria over here. Now we want to be buying the stock when the current dividend yield is higher than the 5-year average yield. So the current dividend yield, we can see it's 4.07%, which is higher than the average of 2.39%. So it's definitely a buy. NTAP, NTAP, definitely a buy at this price target. So Google Finance, definitely from a dividend perspective. And now let's see, just for fun, we know that it meets our dividend criteria. We're getting 4% just for owning the stock, which is definitely an attractive buy. at its current valuations. Now let's see if it meets our value propositions or our value portfolio criteria. So in order for a company to meet my value portfolio, it needs to meet 5 rules this time, right? So these 5 rules are based on these 3 books that I read: The New Buffettology by Mary Buffett and David Clark. Mary Buffett is the daughter-in-law of the famous Oracle of Omaha, Warren Buffett, or used to be. Now, the second book is Rule Number 1, Investing by Phil Town, and the third book is The Little Book That Still Beats the Market by Joel Greenblatt, which is an absolute joy to read, and where he discusses about his magic formula and the profitability of the companies, right? So the 5 rules are as follows. The rule number 1 is that the return on invested capital should be greater than or equal to 10. So return on invested capital is basically the profitability of the company. Greater the percentage, the more profitable the company is, right? And rule number 2 is that it needs to have a consistent net cash flows. So you want to be buying companies where the cash flows are consistent and we can project into the future, or like 10 years from now, to a certain extent, or ballpark it, right? Rule number 3 is that it needs to have a strong balance sheet. So generally companies take on long-term debt in order to expel or accelerate the growth of the company, but we want to be making sure that the long-term debt isn't crazy, that it takes company 50 or 100 years to clear it off. We want to be making sure that the rule of thumb is that it needs to be less than 6 years or less in order to clear off the long-term debt from its balance sheet. And rule number 4 is, and rule number 5 is the buy criteria at which would be considered buying the stock if we were to look at this current valuations. So rule number 4 is that if the current price is at least at an 80% of its fair price, which is basically a 20% markdown from its fair price, then we will be considering to buy the stock. And rule number 5 is we will only look at that when rule number 4 isn't met. If the current price to earnings multiple is less than 50% of the highest price to earnings ratio over the past 5 years, and it is lesser than the S&P 500 index. So coming to this, let's just open up Y charts here again. I have all the tables populated. So NTAP, return on invested capital, pretty phenomenal, 34.17. And the lowest that I could find is 4.53. That was back in 2016. So there are some undulations in the return on invested capital, but currently it has 34.17. The revenue that it has, right? The revenue has been falling, hasn't increased that much, along with the free cash flows as well, which is not a positive sign, but nonetheless, the cash flows are consistent to a certain extent. Now, looking at the balance sheet, we can see that the company has around $2.78 billion in long-term debt, which it easily can cover with its current assets. So current assets are nothing but the assets that can be liquidated into cash within a span of 12 months. So they're the most liquid assets that can be converted on the balance sheet. So it can clear it off within the next coming 12 months if the management chooses to do so. So definitely a buy. A strong balance sheet. Now let's look at the current valuations. So the earnings per share currently is $3.47. And now let's have a look at the average range at which NTAP has been price to earnings multiple. It has been trading for over the past 5 years, 8.318 and 275.67. NTAP. And the analysts are expecting the company to grow at around 3.90%. Okay, so what we'll be doing here with this Excel calculator or this Google spreadsheet calculator is we're going to be taking this $3.47 10 years from now by multiplying it with the analyst estimates growth rate, and once we arrive at an X figure of the earnings per share 10 years from now, we want to be multiplying with the appropriate factor. So the appropriate price to earnings multiple, you can either consider the average or you can consider twice the analyst estimates, so that we can get a ballpark figure at which the stock might be at 10 years from now. So looking at this, you can look at NTAP stock, and the intrinsic value 10 years from now would be somewhere around $38.19 according to this valuation. And the fair price or the price at which we should consider buying the stock should be around $8.69 per share. Since it doesn't meet the criteria, we definitely can't buy it based on this value perspective. But in terms of rule number 5, we can see that the price to earnings multiple is definitely lower. The current price to earnings multiple is definitely lower than the highest 5-year price to earnings multiple, and it is lesser than the S&P 500 index. So it's definitely a buy based on the value proposition that is offered by rule number 5. Okay, now let's have a look at the next company. So 1 down, 4 to go. So Investors Bancorp, ISBC. The market cap is $1.95 billion. Dividend yield is 6.2%. Investors Bancorp is a New Jersey headquartered bank with 154 branches in New Jersey and New York. ISBC stock is very cheap, priced at $7.77 per share for just 73.5% of its 10.57 tangible book value. Okay, so it's trading less than its a book, so that's pretty good. So moreover, the dividend yield for ISBC stock is attractive at 6.2%, and over the last 12 months the company made 73 cents per share, which more than covers its 48 cents dividend share. Additionally, the stock trades for just 10 times expected earnings for the next year, and if you put all of these together, you have a very cheap stock to buy. Obviously, the bank has been hit by the real estate troubles, and even with the loan provisions, it has still made 18 cents per share in quarter 2 or in second quarter. This more than covered the 12 cents per share quarterly dividend. My estimate of this company's value is $14.95 per share, or 88% above the current price today. This may take 2 or 3 years to recover, but that implies an annualized return of 23.4% in each of these 3 years. And with the 6.2% dividend yield, the stock has an estimated annual total return over 29% annually. Again, that is a great return on investment. Okay, now let's have a look and see if Investors Bancorp meets our dividend portfolio rules. 10.53, definitely cheaper when compared to the S&P 500 index. In terms of price to earnings multiple, ISBC. Revenue increasing substantially. Free cash flows hasn't moved that much. It has been in fact decreasing because it was around $153 million. Now it's around $143 million. So the free cash flows are definitely a positive over here. And now let's have a look at the total dividends that are being paid out. So 122.16 divided by 143.19. So that equates to around 85% of the dividends. So we want to be really on the conservative side. This needs to be less than 75% in order for us to invest into it. But this current valuation doesn't belong in our dividend portfolio, and the current free cash flow that it's able to generate, I won't be even considering for the value proposition. But nonetheless, it does seem to be a pretty good stock which has a really good attractive yield, but I want to be on the conservative side and sleep well at night knowing that the company that I've invested in is a really great company, right? So the third company in the list is Key Corp, ticker symbol KEY. Market capitalization is $12.46 billion. The dividend yield is 10.4%. So Key Corp is a Cleveland-based bank with almost 1,100 branches in 15 states. Currently, the bank has $171 billion in assets and $15.6 billion in shareholders' equity. More importantly, though, Key stock trades for just 94% of its 13.07 tangible book value per share. Overall, Key stock has an attractive 10% dividend yield and trades for 10 times forward earnings. And in the last 12 months, the company made $1.12 per share, which is more than covers its 78 cents dividend per share. And this was after just taking $482 million credit loss provision. Nevertheless, its revenue for Q2 was up 17% in quarterly succession, mainly from fees, consumer banking, and its capital market division. Based on its 3.15% average annual yield over the past 4 years, Key stock is worth over $40 per share. That represents a price rise of over $200 more, 200% more than today's price. In addition, based on the average price to earnings ratio over the past 5 years, the stock is worth 48% more. In fact, on average, it is worth $29.30 or 130% over today's price of $12.77. So assuming it takes 3 years to reach this price, the average annual gain on a compounded basis is 33.7% annually, and with the dividend yield, the company expected return is over 43% annually for the next 3 years. All right, now let's have a look at the company Key Corp. Okay, where did I enter that? Oops. Yep. 11.03, definitely a discount on a price to earnings perspective. Now let's see if it meets our dividend portfolio. So as we can see, the revenues have been increasing, but the free cash flows haven't moved that much. So it is a little bit alarming, but nevertheless, it has been paying out dividends. Let's see how much this equate to. So $804 million divided by 2.821. That's around 28%. So around 30% of its free cash flow is being paid out as dividends. So the remaining 70% can be reinvested back into the business. So definitely meets our second point in our checklist. And how long has Key been increasing its dividends? So it has been paying dividends since 1995, but it has only been increasing its dividends over the past 3 years at a rate of around 29%. So I wouldn't be too keen on investing in this company as a dividend perspective, because you never know when the dividend is going to be deducted or it's going to be stopped increasing. So it doesn't do any good for your compounding effect if you do decide to invest back into the business, right? As a result, it cannot belong in a part of our dividend portfolio, but we can see if it meets our value portfolio criteria, right? Type in Key Corp. So the return on invested capital is 5.73, not that attractive. We already analyzed the cash flows. It's pretty good. The long-term debt is $15.45 billion, which it should easily clear off with its current assets. So definitely a strong balance sheet. Now let's have a look at the earnings per share, 1.13. And the range at which the stock has been trading in terms of its price to earnings multiple, 5.037, 23.90. Okay. And then just type in Key for the analyst estimates. They're expecting that the company would be decreasing growth. So as a result, since we can't take a negative growth number, you can be considering this stock at its current valuation, but with rule number 4, but we can consider looking at rule number 5. So the current price to earnings is less than 50%. Yes, definitely. And it is lesser than the S&P 500 index. So Key stock cannot belong as a dividend portfolio, but definitely does belong in our value proposition under rule number 5. The next company in this list is Phillips 66, PSX. Market capitalization $27 billion, and the dividend yield is 6%. Phillips 66 is a downstream and midstream company that owns or has stakes in 13 refineries. It was spun off from ConocoPhillips to its shareholders in April 2012, and right now the company pays a 90 cents per share quarterly dividend or $3.60 per share annually. Overall, at the current price of $61.79 per share, PSX stock has an ample 6% dividend yield. That said, this high yield is more than covered by its company's expected earnings by next year. For example, analysts expect Phillips 66 to make $1.08 this year and $5.42 per share in 2021. Nonetheless, the high numbers for 2021 obviously depend on the price of oil rising next year. This is based on the economy returning to the normal with the CBVPD vaccine that is effective and abundantly available. So based on the company's average historical yield and average historical PE ratio, PSX stock is worth $120.87 per share. That represents a gain of 101% in the stock price. And assuming it takes 2 years for the stock to hit its target, it represents a compounding annual growth rate of around 41.7% each year. With a 6% annual yield, the expected total return is 47.7% annually over 2 years. Okay, Phillips 66, PSX. Okay, so it doesn't have a positive price to earnings ratio because its earnings is negative at the moment. Let's see if it meets our dividend portfolio criteria. PSX. So the free cash flows must be positive. Definitely it's a positive at the moment. And the dividend it's paying out is $1.57 billion, which is more than the amount of free cash flows that it currently has. As a result, I wouldn't even be considering this as a dividend portfolio or our value portfolio. Now let's have a look at the last and final company, which is AT&T, ticker symbol T. Market capitalization is $214.3 billion. The dividend yield is 6.9%. AT&T is a diversified telecom, media, and technology TMT services company with more than $175 billion in revenue in the last 12 months ending June. Right now, the stock is attractive with a 6.94% dividend yield and 9.3 times forward PE ratio. Moreover, analysts polled by Yahoo Finance estimate that AT&T will make $3.19 per share this year and $3.24 per share next year. That said, this is enough earning powers to cover its $2.04 annual dividend per share. I estimate the stock is worth $34.43 based on its average 6% dividend yield over the past 4 years. In addition, its historical PE ratio of 13.8 times implies a stock price of $44.83 per share. In turn, the average of these two is $39.58 or 38% above the current price of $30 per share. So assuming it takes 2 years to reach this target price, the average compounding annual rate is around 14.9% annually, and combined with the 6.9% dividend yield, the total expected return is 21.8% annually over 2 years. Now let's have a look at AT&T stock. It's pretty simple. The ticker symbol is just T. So definitely on a discount when compared to the S&P 500 index average PE ratio. Now let's see if it belongs in our dividend portfolio. So the revenue has been increasing along with its free cash flows. So you could say that it nearly doubled, so around 10% year over year compounding annual growth rate if you were to eyeball it. And it pays out a dividend of $14.89 billion. So 14.89 divided by 29.23, that only accounts to around 50% of the dividends. So the remaining 50% can be reinvested back into the business. So definitely meets our second point in our checklist. Now let's see how long AT&T has been growing its dividends. So looking at this, we can see that AT&T belongs to a unique category of companies called the dividend aristocrats, which have been increasing its dividends over the past 25 years. So it's been growing its dividend at a rate of around 2.21% over the past 25 years. So definitely meets our third principle in our dividend portfolio criteria. And now let's see if it's the right time to buy the stock. So the current dividend yield for AT&T is 6.93 and the average dividend yield is 5.62. So it's definitely a buy in terms of a dividend perspective because of the current valuations or the current price that it has. Okay, now let's have a look at the value proposition to see if it does also belong in our value portfolio as well. So AT&T, the return on invested capital is 3.79%. We know that it hasn't reached, like occasionally it did tip over 10%, but this is more of a stable company. It's not a growth company. That's why it's not able to project the return on invested capital that much. The consistency of the free cash flows is pretty good, as we can expect that the company to grow its future cash flows at a 10% year over year by a minimum. And the long-term debt, it has around $168 billion in long-term debt. So 0.96. Okay, so $168.96 minus 56.55. So it has around $112 billion after, like $110 billion after considering the current assets. So let's just assume 112 divided by 15. So it would take around 7.46 years in order to clear off its total long-term debt. It could be because of all the acquisitions that it might have made recently, but it is very close to our 6 ballpoint figure. I would say it does have a pretty good, strong balance sheet. Not too shabby, but it is a little bit close to the chest. Now let's see if we can project the projections of the earnings per share. So the current earnings per share is $1.63, and the price to earnings multiple, yeah, it needs to be capital letters, is 5.172, 36.77. AT&T growth rate is going to be around 0.29%. So that's just pretty crazy, and it won't even reach our price criteria under rule number 4 for fair price, because we should be buying the stock at around 22 cents per share, which we know that it might not even come to that particular level. But in terms of the rule number 5, it is at a 50% markdown when compared to the highest price to earnings multiple, and not only that, it is cheaper than the S&P 500 index. As a result, we can consider looking at investing into AT&T as a dividend perspective and as a value perspective in terms of its price to earnings multiples. So, summary of cheap high yield stocks. The table here shows that these 5 cheap stocks to buy that have an average dividend yield of 6.8% and an average PE ratio of just 10.7 times. That is very cheap. Moreover, the average upside of each of these stocks is 83.4%. Even it takes an average of 2.4 years, that is to the end of 2022, to reach these targets. The average compounded return is 28.6% annually. Okay, so that's the calculations that the writer has done. So if you include the 6.8% dividend yield each year, the expected return will be 35.4% each year. And these are excellent expected returns for most investors. On the date of publication, Mark R. Hake held a position in ISBC. Mark Hake runs the Total Yield Value Guide, which you can review here. Okay. Thank you so much, guys. If you have stayed around till this part of the video and you're listening to this part, I really appreciate it. And full disclosure, guys, this video is for your education and your entertainment purposes only, and there is no guarantee that you will earn any money using the techniques and the ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So, catch you in the next video. Until next time, peace.